This lecture is on valuing common stock and also on some of the features of common stock. Our goals here are to describe characteristics of common stock and develop a basic pricing model for a finite period common stock. So in other words, we're developing a model to price a stock that I'm going to hold for a fixed amount of time. We're going to sort of describe the pros and cons of this model, and then we're going to work through an example. In valuing common stock, just like valuing bonds, we're always valuing what will I receive. And we're going to take the present value of the cash flows I receive from holding the common stock. Now the problem here is with bonds, everything is known in advance. With common stock, it's not. The value of a future dividend is difficult at best to predict. So we're going to have several issues here with valuing common stock, but like anything, we've got to do the best we can. Here's some of the basics of common stock. First, it represents residual ownership of the firm. So essentially it means you get what's left every quarter after the firm pays other investors. You're last in line. With common stock, you have dividend rights, meaning you have equal rights to any dividends that are paid. It does not require the firm to pay a dividend, however. You also have ownership. Based on the number of shares you can have a certain number of votes in selecting the firm's board of directors and CEO. The problem is, it's basic majority rules. So whoever has the most shares of stock has the most votes and therefore controls the future of the firm. For example, Warren Buffett owns a large stake in Coca-Cola. So his multi-million number of shares dwarfs my 50 shares that I own. So let's keep that in mind. You have voting rights, but not that much power. An important part of stock is the idea of preemptive right. That basically means if I own shares or if I have purchased shares of stock, I have the right to participate in any new shares offered by the company. A good example of this is the movie Social Network, about the history of Facebook. There's a key moment in that film where one of Zuckerberg's early partners, he's offered shares in the company, or a percentage, and then you turn around 20 minutes later in the film, and he has no power anymore because they've turned around and issued new shares to everyone but him. He eventually sued Zuckerberg of Facebook and I think made $600 million, something like that. But the point is, if I own shares in a company, you can't dilute my ownership by giving everyone else shares and not giving me the same opportunity to participate. One other key feature of common stock: the dividends are not constant. So with bonds, we were able to have constant coupon payments, and it made the valuation relatively straightforward. With common stock, it isn't that case. And it's also difficult to predict what a future selling price is going to be. With a bond, we knew we would get our face value back when the bond matures. With stock, we have no idea what the selling price of a stock will be, even tomorrow, much less 5-6 years from now. So we're going to have to overcome some issues when we do our valuation model. First, let's start with a simple one-period model. We think of this like a present value and a future value. The present value would be what I pay for the stock today. We'll call that P0. The future value would be what I receive in 1 year. Well, if we think about it, we might get a dividend next year, and we might also be able to sell the stock for a certain value. So our future value then is just P1 plus D1. And if you look at that equation I have, it's really the present value of a cash flow. We're just thinking our cash flow in 1 year will be the dividend plus a future selling price. Now R here is the return I require to hold the stock. And that's sort of based on the risk of the investment. So the riskier the stock, the greater the return I might ask for. Let's look at a simple example. We think Coke will trade at $60 in 1 year. And Coke announces they'll issue a dividend of $4 next year as well. If the required return is 15%, what should the current price be? So my future cash flow for owning this stock would be $60 in 1 year plus the $4 dividend. So my future cash flow would be $64. I want a 15% return, so if we think about time value of money, I'm just going to discount $64 at a rate of 15%. So the equivalent value today would be $55.65. That's what we call the intrinsic value, or the value I place on the stock today. Well, we want to make this more realistic. And a realistic way to think about this is most investors don't hold their stock for just 1 year. They're going to hold for multiple years or multiple periods. So we want to apply our finite model to what we'll say in periods. So what we're going to need to do is get dividends for every period up until the year you sell the stock. And we're going to find the present value of all those dividends, and then we're going to find the present value of the future selling price. So what we're calculating here is an intrinsic value, or the value today that I place on the stock. Now remember, the key thing here is we're making assumptions. We're assuming what future dividends might be, and we're also applying a discount rate to the stock that's based on the return I want. So we got to be careful. Here's how we would formulate this. It's really the present value of the cash flow stream if you look at this. Instead of cash flows, we have dividends. And at time n, we have a selling price of Pn. So we'll find the present value of each one of these future cash flows in today's dollars, and we'll add them up. That'll give me the value that I place on this investment today. Well, hit pause and read through this example, and then we'll work through the solution. All right, with Rudy's Survival Technologies, we have a 3-period holding period. So in other words, I'm going to buy the stock today and hold it for 3 years. So in the next 3 years, I'll get 3 dividends. And then at the final year, year 3, I can sell the stock for $14.82. It says we estimate a discount rate of 22% for this firm. What value would I assign Rudy's Survival Technologies? Well, here's our by-hand solution. We simply discount every dividend back to today. So we had $247 in 1 year, so we discount that by just 1 plus the discount rate. $353 is 2 years from now, so I discount that 2 years at 1.22 squared. Then $376 and $14.82, that's the selling price. We would discount those 3 years back to today because we would receive those 3 years from now. We'll solve using the cash flow keys on your calculator. So simply hit the cash flow key. The cash flow at time 0 is 0. The cash flow at time 1 is $2.47. The cash flow at time 2 is $3.53. The cash flow at time 3 is $18.58. I got $18.58 by adding the dividend and the selling price. Just as a reminder, if you're having trouble using the calculator, please look at our class homepage, and I have a file up with a basic calculator tutorial. And cash flows is one of the items I have on there. So hit the NPV key, put in the interest rate, and then hit compute NPV. We get $14.63. Now the way I think about this is the value I place on the stock today. So let's apply it to real life. If I think the stock is worth $14.63, let's say for instance that I saw it trading at $14 on the market. Well, that's a great buying opportunity for me because I place more value on this stock than what it trades at right now. You see what I mean? Intrinsic value is the most I'm willing to pay for a stock. If it's priced less than my reservation value or maximum price, it's a good buy. If the stock is priced higher than what I'm willing to pay, I shouldn't buy it. I'd be paying too much. Now, if we look at this model, there's a couple of weaknesses, and we've sort of already mentioned them before. One, predicting dividends is a difficult challenge. Predicting a future selling price is somewhat impossible because just think about reality. If we knew what a stock would trade at 3 years from now, we could make a fortune. So that's not going to happen. So we're going to have to figure out a way to get around predicting a future selling price. And then finally, estimating the discount rate. We can do it, but we have to be careful. And it's easy to make errors when we predict what the required return for a stock should be. Now, as we finish this slideshow, let me go back to one slide. We're going to address the finite model by we're going to use what we call the infinite model. So in other words, we're going to think about holding a stock forever. So our next set of lecture slides or video will deal with what we call the infinite model.